Imagine back in 2020 when the market was soaring, headline about cryptocurrency going up, or even just recently back in November where indices were going through the roof. S&P 500 was at a all-time high for the year. And if you weren't trading during that day, there is a feeling that you weren't being part of the crowd, that you were missing out on a golden opportunity. This, my friend, is FOMO, fear of missing out. It has lured countless traders into the pitfall of trading, blowing their account and destroying their trading career. Welcome to MindEdge Trading, where we transform market anxiety into market mastery. I am Menelik, and today we are tackling one of the biggest psychological challenges in trading, FOMO, short for fear of missing out. We have all been there, where we have seen the asset classes that we are trading going through the roof, or the trades that we were speculating on working, but we are not being part of the trade. Or sometimes we get a tip from our friends or trading guru on social media, and we've seen people making substantial gains, but we're not part of that crowd. But is jumping in head first really the right move? Let's break down what FOMO really is and why giving into it can lead to a trader downfall. The first trigger, which is media, Twitter, Instagram, YouTube, TikTok, sometimes any media where people are live streaming their trade, are showing their gain, their financial gain in the market. These media's outlet can have a psychological impact on how you perform and how you feel about your trade, because sometimes it will make you feel as if you are missing out, or you are missing out the right trade, or you are missing out a golden opportunity, because it seems like everybody is making money and you are not making money, or you are on the sideline, or that you are not making enough because everybody is showcasing how much they're making and always seems to be making a lot more than what you're making. So that can have a psychological impact on you to put a pressure on yourself to trade, take low probability trade, to trade when you're not supposed to, and to deviate from your trading plan. It is human nature to want to be part of the winning crowd. So when we see other people winning, it's part of the social proof that they are successful traders, that they are being successful in the market. And when you're not doing the same thing, there's a part of you, if you are not aware of that part of you, your subconscious, that want to showcase that as well. That part will manifest in your trading if you just give into FOMO, or giving to that feeling or that emotion of feeling of missing out. The second trigger will be market trend. When a particular asset class that we're trading, like cryptocurrency, the indices, or Forex, sometimes becomes a hot trend, and you have never traded crypto before, you feel like you're missing out, that everybody is on the right market, that you should be in crypto, but you don't have any knowledge on how the crypto market is working, and then you haven't done any research prior to that, and you get yourself into that because you're afraid that you're missing out a golden opportunity or way to make easy money. This trigger, combined with the fast-paced environment of the market, create a perfect storm for FOMO. But it's not about recognizing this trigger, it's about understanding how the market environment fuel them and make traders make irrational trading decisions that leads to their downfall, to loss of money, loss of capital, and sometimes loss of trading career. This is why I personally don't trade news such as NFP or FOMC. There are traders that trade it, but it's not the right time to trade, because anything can happen. You can lose a lot of money during those times. And in this high-stake environment, it is easy to get swept up in the moment and forget the fundamental of trading, the fundamental of risk management, the fundamental of your trading plan and your trading strategy, which this is where FOMO can become really dangerous, leading traders to make often impulsive trading decision that comes at a high cost of their capital, cost of the trading, cost of the trading career. Now let's talk about a couple strategy to maintain discipline and make rational decisions that can help you avoid FOMO and make better trading decisions in the future. The first strategy is to set clear trading goals and limits. This means defining what you want to achieve and how much you are willing to risk. As you define those things in your trading plan and you start trading, you are not going to deviate from it just because of the hype of the market. If you have a clear set goal and timeline of how much you want to make and how much you're willing to risk to make that on a large enough timeline, not making money quick, but making money consistently and slowly, you will, and you trust your strategy, probably you are not going to get swept up by FOMO by the fact that everybody's making money because you are working on your own timeline. The second strategy is to conduct thorough research about the market class that you are trading, about your trading strategy, and to understand the asset that you are trading, to understand that there are times that there are going to be volatility. NFPs, there are times that the market is just going to move, and you may miss those moves, and that's okay, because the market always goes ups and goes down. There's always an opportunity to find a better entry and to take the highest probability setup, not the C plus setup or the average or the guessing setup, or the setups that you are just being impulsive and hoping to make money on it. And remember, informed decision, reduced regrets. And in trading, if you can reduce your regret as much as possible by informing yourself, by understanding what you're doing and knowing exactly what you're doing, that will be the best. The third strategy will be to practice emotional discipline. Trading is not just about strategy, it is also about mindset. Don't let your emotion drive your decision. Take the time, breathe, and think logically. That's why I think mindfulness should be a biggest part of any trader's practices, because it helps you regulate yourself, give you a better emotional control, so that you are not making impulsive decisions in the market, so that when things are moving, you are fine with the market moving and not being part of those moves. Because sometimes the best trades to take are the ones that you don't take, and you protect your capital. So developing a strong emotional control in the market will reduce impulsiveness and impulsive trading. And finally, the last strategy will be to embrace long-term perspective. I know, like I said, one of the triggers of FOMO is social proof or news outlet, where we see other people's result of trading, and we comes into the trading field thinking that we're gonna make money quick and make a lot of money quick, which is not realistic. So if you decide to take trading seriously, you will probably embrace long-term perspective and understand that the market always moves up and down. There is always going to be an opportunity in the market, and that you are okay to miss a move. If the market is jarring up and you have not been part of it, that is fine, because like I said, the best trade are usually the one you don't take. Have a long-term strategy. Plan your trading for a year or two. Have a strategy and look for consistency on the long-term horizon, not to get funded within a day, not to make huge payout within a day or a couple of weeks, but understand that if you apply good risk management and you have tested and proven that your strategy can work consistently, over time your result will be exponential. So as long as you are slow with it and you have a long-term perspective, you are not just gonna jump into the market, make impulsive decision, because you already have a plan that you are following and you are trusting that plan, you are trusting that strategy to take you to the long horizon. And it's not something that you're just doing it for today. It's a career. It's something that is going to grow over time, not within a couple of days, at least a year, 6 months or so. By implementing this strategy, you are not just combating FOMO, but you're setting yourself up for more consistent and efficient and sustainable success in trading. Now, let's look at the concept of JOMO, which is the joy of missing out. JOMO is all about finding satisfaction in staying true to your trading strategy. Like I said earlier, one of the strategy is to maintain discipline and make rational decisions in the market. So having satisfaction doing so is kind of like a gain, even if you are not making money. But as long as you follow your trading plan, psychologically you will feel good about yourself, you'll feel good about the discipline, and you'll feel good about your trading career. And if everything falls according to your trading plan, you are winning anyway. Embracing JOMO means celebrating your discipline and decision making. Even if it means missing out on what seems like a golden opportunity, it's all about playing the long game. Remember, in trading, patience and discipline are not just virtues, they are your most valuable asset. You have to be patient, you have to be disciplined with your trading plan, and then patient with your trading goal. As we wrap up, I want you to keep in mind that every trader's journey is unique. You are going to have some ups and downs, and remember, the downs are always learning opportunities. Have had some failure. Last year, I've had some busts, I've had losses, and learning from those losses, I feel much better and much more complete as a trader now than back then. So I hope it's the same thing for you. And it's everyone has their own journey. Find your path, trust your strategy, and let the market ups and down be a lesson, not regret, not source of regrets. Until next time, my friend, happy trading. See you in the next video. Peace.